What if I told you that a country most people barely think about anymore could quietly shake your stock portfolio, your interest rates, and even the next global recession? This is not about the United States. It is not about China. It is about Japan. A country with just 2% of the world's population, but a financial footprint so large that when it sneezes, global markets catch a cold. And right now, Japan is not feeling very well. In early 2025, Japan released economic data that barely made headlines outside Asia. Growth slowed, consumer spending weakened, inflation stayed uncomfortable. At the same time, Japan's biggest auto giants started warning investors that profits were under pressure and that the road ahead would not be smooth. Rice prices remained stubbornly high. Families were cutting back. Businesses were struggling to keep prices affordable. On the surface, this looked like a local problem, but beneath that calm surface, something much bigger was unfolding. Something that could raise interest rates in your country, crash global markets, and expose the fragile foundation of the entire financial system. Because Japan is not just another economy. Japan is one of the largest creditors the world has ever known. It holds over $1 trillion in U.S. government debt. For decades, it quietly funded global growth, cheap loans, rising asset prices, and risky bets through one simple mechanism: cheap money. And now, that era is ending. To understand why this matters, you have to understand Japan's biggest problem, and it is not inflation or interest rates, it is demographics. Japan is the oldest major economy on Earth. Nearly 1/3 of its population is over the age of 65. Birth rates have been below replacement for decades. The population has been shrinking since 2008. By 2050, Japan is expected to lose around 20 million people, roughly the population of Florida. This is not just a social issue. It is an economic time bomb. Fewer workers mean slower growth. More retirees mean higher government spending. Healthcare costs rise. Tax revenue falls. And when that happens, governments do the only thing they can do to survive. They borrow. That is why Japan's debt-to-GDP ratio is over 250%, the highest in the developed world. For years, Japan managed this without a crisis. Interest rates were near zero. The Bank of Japan printed money and bought government bonds. Investors stayed calm. The system looked stable. But stability was an illusion created by cheap money. Because while Japan's domestic economy struggled, Japanese money flowed outward. Investors borrowed yen at near zero interest and sent that money overseas. They bought US stocks, bonds, real estate, emerging markets, and anything that offered higher returns. This became known as the yen carry trade. It was one of the most powerful financial engines of the last 30 years. Borrow cheap yen, convert it into dollars, buy higher-yielding assets, pocket the difference. When U.S. interest rates hit 5% while Japan stayed near zero, this trade exploded. Hundreds of billions, possibly trillions, flowed through this system. And almost nobody questioned it, because it worked. Until it didn't. In 2024, the Bank of Japan did something unthinkable. It raised interest rates for the first time in decades. The yen strengthened rapidly, and suddenly that free money glitch stopped working. When the yen rises, borrowers lose money. When rates rise, leverage breaks, and that is exactly what we saw. Japanese stocks crashed in days. US stocks wobbled. Crypto fell. JP Morgan warned that the unwind had only just begun. And now in 2025 it is still unfolding. Slowly, quietly, dangerously. Japanese government bonds are now under pressure. Yields on 30-year bonds crossed 3%. 40-year bonds hit record highs. Bond auctions started failing. Investors demanded higher returns to hold what were once considered the safest assets in the country. And this matters because Japan cannot afford higher interest rates. A 1% increase in rates adds tens of billions of dollars in annual interest payments. That alone rivals Japan's entire defense budget. The Bank of Japan owns more than half of the bond market. It has printed money for years to suppress yields. But even central banks have limits, and markets are starting to test those limits. Now here is where Japan becomes your problem. Because when Japanese investors stop sending money abroad, global liquidity shrinks. When they stop buying US treasuries, US borrowing costs rise. When they start selling, yields spike, mortgage rates go up, stocks reprice, risk assets suffer. This is not theory. Japanese institutions have already reduced foreign bond exposure. Officials have even hinted that US Treasury holdings could be used as leverage. Even joking about that tells you how serious this has become. And at the same time, something strange is happening. As trust in bonds weakens, money is looking for alternatives. In Japan, companies like Metaplanet have exploded in value simply because investors see them as protection against bond instability. Bitcoin quietly reached new highs while most people weren't paying attention. Search interest remained low. Media coverage stayed muted. But under the surface, a shift is happening. Not because Bitcoin is magic, but because the old system is showing cracks. This is not just Japan's story. It is the story of the end of cheap money. The US is not far behind. Europe is struggling. Global debt is at record highs. Governments cannot raise taxes fast enough. They will not cut spending. Default is politically impossible. That leaves one option. Inflate the debt away. Devalue currencies. Extend and pretend. As Lynn Alden says, nothing stops this train. And when people realize that, capital moves toward assets that cannot be printed. Assets outside the system. That does not mean everything collapses tomorrow. This is a slow motion process. But slow does not mean harmless. It means persistent volatility. Higher rates. More crashes. More bailouts. More distortions. Japan is simply the first domino people are noticing again. The quiet creditor that once stabilized the world may now destabilize it. And the biggest question is not whether this matters. It is how prepared you are when it finally does. So here is the real question I want to leave you with. If the world's safest bonds are no longer safe, if cheap money is truly over, and if debt keeps rising no matter what politicians promise, where do you think money goes next? Let me know what you think in the comments. And if you want more deep, no-nonsense breakdowns like this that actually explain what's happening behind the headlines, you already know what to do.